Hello, Warriors. Welcome to the day before the NFP. So I know I'm not looking to do much today. Hi,
Dale.
Ryan.
How's
Brock.
my sound today?
Better.
Good. I'm trying
Perfect.
so many different things.
All right, no, you've got it now, buddy. I thought you were, auditioning for Sea Hunt. You're probably too young to remember that.
No, I
TV
remember
show.
Chips.
Lloyd Bridges was a, scuba diver. Hello, Richard Adams, Hugo, Brock, everyone doing okay? So probably a lot of jockeying around for the number tomorrow. Hope all you unemployed traders won't be celebrating Labor Day. Oh, are you kidding me? This is intense mental labor. Okay, so we'll be celebrating it. And, just looking around, cable outperforming euro, little double top up here at 1855. Still don't think that this rally is over. Pullbacks could happen at any time. I think we have to now, if you're still long euro and you haven't taken any profits, you may want to do so before the NFP tomorrow. And I think this really should be the area, this little pullback that we had from here to 1790, back under 1780, the uptrend will be questionable. So, you keep moving it along, at first, your stop is here and then it's here and then it's here. So you keep trailing it and, letting something ride, because I still think 1960 or 120 is doable. It's probably going to have a lot to do with what happens tomorrow with the number. I saw Blake's tweet about what the yen is doing to people. I won't say the word, but definitely has been difficult. I keep looking at yields and they just seem heavy to me. But that could all change in a heartbeat in a New York minute tomorrow. I think you just have to go with the range here on yields, back under 121, I think we'll challenge the lows, and back over 136, I think we're going to, 160 for starters. So that's the way that looks. Metals are acting okay. I can't get long gold here, and I think it's premature to get short. Still think there'll be a chance down here in the coming weeks. That's what I'm waiting for. Silver beginning to outperform gold a little bit. I think it's got to hold this 2340. And actually, the gold silver ratio is starting to come in. It really wasn't much of a recovery, if this is all there is to it, because, it was a 23% retracement of this move. That's enough, that could be it, where silver begins to outperform. And we head down one more time. To me, it's going to be back under 71. So I'm not ready to abort that trend yet. But silver definitely outperforming the last couple of days. That's why you see this, right? And the S&Ps actually had a failing rally yesterday, right here. And we have a little trend break. Doesn't mean it can't rally up one more time. I mean, you do have confirmed highs. You won't next time. And I just want to leave you guys with one chart. The largest market cap, I think, on the planet. Would you buy this chart? So it almost got to the wedge line. Still could. And then here, look at the weekly. What do you think? So people think I'm nuts when I say, if we do get a breakdown, that we could cut the price of Apple in half. That 75 is possible, the pre-COVID highs, 85, but that's not a market I'd be long. And look at all the non-confirmations here.
You're nuts.
So, huh?
You're
I'm
nuts.
75. There's a worm in the apple. You know, you don't want to eat an apple with a worm in it, do you?
Why not?
Huh?
Why
You drink.
not?
I mean, I've had a shot of tequila with a worm in it, but at
There
least
you go.
huh?
There you
Anyway,
go.
so what do you think, Steve, with what's going on here, man? You know, what's the market looking for? 800,000 tomorrow? 600?
As
Consensus?
we talked about it briefly yesterday in the morning edge.
Yeah.
And I don't know if I made mention in face. I think that the Fed is trying to persuade us that we're in the most data relevant time.
Yeah.
I think that the exact opposite is the case. I think that we are in the least data relevant point in time. Having to do with central banks, the most important relevant data is inflation. So what happens now that inflation is at 6%? Does it still seem relevant to them? No.
Yeah.
They're just trying to persuade us that they're data dependent when in essence they've proved that they're not. I know that the market is still going to, keep believing this. So the market is going to keep erratically reacting to like whatever data we get. But I think that the market still hasn't realized that, the Fed is in a predetermined path, almost irrespective of the data. And as I said, they've proved it because they've already showed that they're completely numb to what happens to the most relevant data having to do with monetary policy.
You know what our friend Peter Bookvar says about the Fed, right?
Yes, that they are S&P dependent.
Yeah.
I totally agree. That's
Yeah,
exactly what they are. And there is a good reason for that, because the real economy is in a really bad situation, not post-COVID, pre-COVID as well.
Yeah.
And, the only thing that gets the whole story going is that, trying to persuade everybody that the markets are a representative of the actual economy. So if that's the case, then you really need to keep the financial markets elevated, right?
What percentage of GDP is the market now, Steve? 200% or something like that?
More than that. It has exceeded that by quite a lot, if I remember right.
So, so if the market goes, we have an economic crisis. If there's
which is inevitable, right? At some point it's going to happen, because you can't keep something inflated forever. Something is going to happen. There's going to be some kind of an event in combination with the fact that perhaps, the time will be such that monetary policy won't be able to push anymore in the same direction, because you know how it is. It's also the law of diminishing effects.
Right.
And we've seen that in action. I mean,
everywhere, China, every dollar.
I said it the other day. Just remember, during what we now call as the Great Recession of 2008, we had one round of quantitative easing and rates going to 1%, and that was enough, right?
Right.
We now supposedly, during a period of big growth post-COVID, we still need 0% rates and 120 billion quantitative easing per month.
Yeah. What a recovery.
Yeah.
Huh? So, you know what, Steve? Well, I really like the point, and a lot of people forget it, that, we were talking about economic problems pre-COVID. Okay. I mean, everyone thinks that, our problems didn't start until the pandemic, but there were lots of problems. The repo market was happening before COVID, where we had that crisis.
And people seem to forget that the monetary policy got reversed before we even heard of COVID. Right?
Yeah,
people seem to forget that.
Yeah. Right. During the repo, when the repo market, banks wouldn't lend to each other. That's when they first started expanding the balance sheet.
Exactly.
Yeah. What do you think about what they're doing with reverse repos, trying to sop up all the liquidity that banks can't have on their balance sheet? A lot of people are saying that's a big problem for the Fed.
In general, we're seeing a sequence. I don't want to focus on one or the other. We're seeing a sequence of problems. It's the usual thing, you try to create a policy to solve problem A, that policy creates problem B,
Yeah,
then
whack-a-mole.
you put a policy in place to solve problem B, which creates a problem C, then you put a policy in place to solve problem C, that creates problem D. That's exactly how the Fed works.
Yeah.
It's a series of policies, all of which have been created one after the other to solve some problem that was created by a previous policy.
Okay.
It's a bit like taxation, right? When the government starts interfering, oh, this we tax this way, oh,
Yeah,
this,
exactly.
this exception, that exception, then you create problems.
Yes.
The thing to do is to let the markets find their own balance. It's difficult, but you have to do that.
Exactly.
Yeah.
They can't do that though. Central banks can't do that. They've got to be seen to be doing something every 5 minutes.
Exactly.
Even the ECB, you know, all of them. You can't have a policy meeting. Very rarely have a policy meeting where there's nothing, where there's exactly the same as the meeting before. There has to be a little line change in the statement, a little bit here, a little bit there, even if it means nothing, just to show
justify their jobs, their existence, right?
Yep.
I mean, you know, that's a bureaucratic type of thing that you have to do reports and everything else just to show that it's worthwhile to have that position. So
I think the global monetary policy has clearly shifted to the following thing. It's more than obvious that there are huge problems, and there is more than obvious that at some point we're going to have to face the music. And since this is unavoidable, right? Of course, the more we prolong the pain, the bigger the pain will be. But since we've already exceeded the point that you could avoid, like, you know, a lot of pain, etc., the policy is now clearly one of just handling and pushing the pain into the future, you know, giving the grenade to somebody else and hoping it's not going to explode in your hands. That's clearly the global policy.
I was thinking about this narrative. What do you guys think of this? And Blake, I'd like to bring in too, unless you're busy shooting. We have a strong number, okay, stronger than expected. So, you know, everyone's going to say, well, yeah, they're going to announce a taper at the next meeting and there's some risk off. And then at the September meeting, they don't begin the taper and we rally, but the market thinks, well, you know, they didn't do it this month, but they have to do it next month, and the market comes under pressure. And that if the market is falling while this is going on after tomorrow, that the market doesn't stabilize until they really start. You know, because the market's going to be worried. Well, they're not doing it now, but for sure next month. They're not doing it now, and then they don't, and the market's relieved. But then the market thinks, well, you know, they didn't do it this month, but they have to do it next month, and maybe during this whole correction they don't do it, if there is one. You know, I know there may never be one, but that's a possibility that the market doesn't stabilize until they do it, because it trades on the fear that they have to. What do you think?
Also, don't forget, we've said this before, tapering is a very broad term, right? What kind of tapering are we talking about? How fast? How frequent? True. Right? Because don't forget that quantitative easing one in its entirety, if I remember right, was 600 billion in its entirety, right? And we're currently buying that in 4.5 months. Roughly, right? Because we are in some kind of QE infinity with 120 billion per month, right? Yeah. So, yeah, okay. If they taper, let's say 20 billion, and then 3 months later they taper another 20 billion, and we still have, let's say, after 4, 5, 6 months from now, we still have 80 billion per month quantitative easing. I mean, is that monetary hawkishness? Is that tightening? I mean,
that's just less.
That is a little bit less of an insane amount of liquidity pumped into the system. That's what it is.
Well, can I just chuck in
that? The market. Go ahead.
Sorry, Dale. Can I just chuck in something? We know we're just talking about central banks and their statements and how they like to change things for the sake of changing them. What if they go a different route? What if they, instead of going, right, we're tapering X amount a month, what if they go, right, we're cutting QE to 80 billion and we're going to run that for 4 months. Then we're going to cut it to 40 billion and run that for 6 months, rather than saying 10 billion a month, 5 billion a month, 20 billion a month. What if they do it in chunks and then prolong the process by giving the market, you're going to get 80 billion of QE for 4-6 months. Then you're going to get 40 billion of QE for 4-6 months, as long as things are progressing. It's those, maybe get some type of change like that. That's not a direct 10 billion a month.
I don't think they will commit to something like that, Ryan. It would be a much better, future indication if that was to happen. But I don't think they want to commit to something like that, because then they're going to be afraid that any change from the predetermined plan, if it is a predetermined plan, will immediately, for example, if they have to slow down the process of tapering, it will immediately send out warning signals. And I don't think they want to take that risk.
I agree with you. I'm just thinking that maybe they'll do something different.
Because if you're asking me, my assumption is that tapering will never reach the point of going back to zero quantitative easing per month before they have to reverse again. I don't think we're going to see a rate hike again before the next cycle. My personal opinion.
Can we take a look at your charts, Steve, and see what you're looking at technically?
Where's Blake? Where did we?
I don't know.
Oh, I've been letting you
He
go.
just grabbed some popcorn and he's
I'm,
listening.
Steve's wound up like a top. I'm just kind of like sitting back, watching him spin around in circles over there. It's awesome. It's awesome. Good morning, guys. How you doing?
Good morning, mate.
Good morning.
Yeah,
Blake.
no, I was just listening to what you had to say, and Steve, I have to sit back and just kind of listen, and I have to, I have to agree with you, and probably mostly because, if you go back pre-COVID, we were dealing with all the same issues, and this is a conversation actually we had a few days ago on, I don't know if it was the Daily Roundup or the Morning Edge, one of the private, ForexAnalytix webinars. By the way, if you guys are just here normally for face, you don't capture everything that we talk about.
Tip of the
Steve,
iceberg, Blake.
I'm sorry?
Face is only the tip of the iceberg.
It is. And in about, I guess in about an hour from right now, we do the Morning Edge. And then even after I'm done doing analysis, Steve goes into a lot of different charts with Stelios, and and then we have the Daily Roundup and the European crossover. There's a lot. So even if you guys are just at $19 a month at the light version, you still get to access all the webinars. Obviously, the premium version, you're in the chat rooms with us and that type of thing too. But I guess I was having this discussion, and like I said, I can't remember exactly what webinar I was having this discussion in. But Steve, we were talking about having the same talk regarding monetary policy that has extended so long, going pre-COVID, and the thing about COVID, I really can't figure out if COVID has accelerated the point in the markets. This is just, if you look at pre-COVID where we were at, we were having these conversations about monetary policy, and here we are, or here we were, 8 years later, talking about this extraordinary liquidity that the central banks are providing, even with years past, and then COVID struck, and here we are with more liquidity being added to the system, and as you pointed out, we're doing multiples of that of our first round of quantitative easing post financial crisis, in just a few months' time, every month. So at what point does the market, I mean, I don't know where the breaking point of the market is, but there's got to be some point where the market, when people realize that the market doesn't sustain off of anything but central bank support.
And in my opinion, Blake, we are definitely at a path that we will find out eventually, right? I mean, I don't see them stopping until we actually have to find out what that
Yeah,
goal is.
and you know, so it's a scary time, but it's also, you know, you have to look at it as also probably one of the most, probably on the cusp of one of the most exciting trading times of maybe the century in history. Yeah, coming up. And the thing is, I don't know when that's going to break, and no one does. So, and you know, I was having this conversation with Brent Donnelly, which, you know, he was the head trader currency trader at HSBC, and he's been, you know, head currency trader for many different firms. And I had an interview with him on the Trader Summit website, and he said one thing which has stuck out ever since I interviewed him. He's like, look, you can complain about the market we have, or you can trade the market we have, right? You know, you have to trade the market you got, or you can sit here and complain about it and, you know, not do anything. So right now, what we have in the markets is we have an ascending wedge, where volatility is very low, and we're grinding higher and higher. There isn't a whole lot to do right now, but I do think that there's, you know, a lot of event risk on the horizon. And I know, Steve, you said that you don't think that data matters, which may or may not be true.
No, I don't think it does. They pretend that it matters, and the market still believes that it matters. So of course we're going to still see reaction.
Then that's what it means to us, right?
Yes,
because we are the market. We as traders. So let me take a step back. Your opinion doesn't matter to the market.
Yeah,
right.
I know very well.
Okay, your opinion doesn't matter to the market. The market's opinion matters, and what the market is focused on is data. And whether you believe it's not important or you believe it's important or not doesn't matter. It's the market where we participate in as traders.
Agreed.
We participate in the market.
The only reason I make this comment. The only reason I make this comment is because my point is that at some point, market participants will realize that the data market matters is just a pretense. That's why I make the point.
But that's irrelevant to us
today,
Friday, right?
Yes, true. Okay, very true.
So the point I'm trying to make is we do have to focus on the data. And we do have, because as Ryan pointed out, Ryan, you pointed out on, I don't know if it was Twitter, I saw some messages I was getting up and trying to wipe the sleep out of my eyes, that we are going into the end of the year where data is going to matter, to maybe not to Steve, and maybe to those of us that don't really, maybe we all think this is all fictitious or whatever, but it is going to matter to the market and the participants that we trade in. So we are going to have to pay attention to it. And I think it is going to be relevant to what we're doing, at least intraday. So that's the point I wanted to make, that I do think that this month's data is going to matter. And Dale, you asked Steve, you know, what he thought, you know, non-farm payroll is going to come in as, and I will sit here and tell you, I have no idea. But if the data comes in just a little weaker, and we don't quite meet the 750,000 jobs that the market's looking for, and we come in around, let's say 600,000 jobs. What's unemployment looking at? I think it's supposed to improve to 5.2%. Let's say it doesn't quite meet that mark and it comes in at 5.3%. I think stocks are going to rip higher. And little miss on the data, but not horrible data. Stocks are going to rip higher, and dollars are going to get crushed because the Fed's going to, that just plays right into their narrative that, as Steve said, they're never going to stop. But if we have some really strong data and we beat every metric, and let's say, some of the inflationary, not the employment data, we start seeing the ISM, labor, force, what people are
hourly
getting paid.
wages.
Thank you very much, Dale. You're way more awake than I am at 5 o'clock in the morning. So good for you.
Really?
Yeah, you know, some of the wage data start to really increase, and we have a strong number. You're going to see the dollar, I think, rip higher, and you're going to see stocks actually start to take it in the chin. And that's something that we obviously have to be focused on going into Friday. And one other thing I want to point out, and then, you know, take you guys' comments. You know, I know Stelios is here. Ryan didn't get a chance to say a whole lot. Steve, any other thoughts really quick? But I wanted to say that, you know, if you look at our here, let me pull this up in the here. This is the news and research room here. This is our DSI from last night. Look at volatility. Daily sentiment index is at 12. Nasdaq's at 87. Pretty strong numbers from an extreme sentiment standpoint. So I am in the camp that you know, we're at risk of seeing some dollar strength and some stock market weakness. In, I know today's Thursday and the days ahead. You know, we have the jobs report coming up tomorrow. So anyway, some thoughts there, guys. Anything to what I just had said?
Not really. I have one thing actually to say, which is interesting. Australia. Did anybody see the trade surplus printed today?
No, but I didn't. But I have to say, I was talking to Chris Weston of Pepperstone Securities last night.
Yeah.
For me, last night is today early morning for him. Everybody's still in lockdown, like crazy.
They're in lockdown.
They've had these draconian measures going on for like a year and a half now.
Plus, China's boycotted a wide range of their products because the Australians have a pro-US foreign policy, etc. So they've got the boycott from China. They're, you know, lockdown, not as bad as New Zealand, but still, it's not. You know, it's quite restricted. And they posted the biggest trade surplus ever. And this is, to put it into perspective, for the last, you know, decades up until 2018, surplus or deficit was plus or minus 2. Hold on, what's a big figure? 2. Hold on, I missed it here. Sorry, 2 billion plus or minus of a surplus or deficit, and the print today was over 12. So this is incredible. And, you know, I've been trying to think about, you know, why this is, and actually it's very simple. You know, basically the stuff that they export has shot up in value in actual price. So they export iron ore, coal, and aluminium, and natural gas and stuff that has gone, you know, double, triple in value. So that kind of makes sense. But overall, this was a really, you know, a blowout number, and the Aussie is obviously going to be liking that. But yeah, very interesting actually. You know, I saw the number, I couldn't believe it, but you know, that's what it is.
It's like the US trade deficits, but in the opposite direction.
So the stuff they import, the prices are relatively stable, but the stuff they export has shot up. So that makes sense.
Yeah.
Anyway, that's the interesting fact of the day.
That is, well, that is, and you're right, Steve. It's exactly the U.S. and opposite, and that's one of the reasons why I actually really do want to buy the Aussie dollar longer term. I want to be long Aussies. I was really hoping it dipped to 70 cents, and I feel like I've missed it. But then again, I'm kind of thinking, for those of you that don't know my, you know, Aussie dollar analysis, I've been looking for the move back down here to 70 cents to be getting long. I want to be aggressively long down here, and I thought that this bear flag completed. I thought it had a little further to go. I thought we'd come down to the 38% retracement this entire move, which comes in basically at 70.50. I thought we'd get there, and we stopped shy and then just ran up like a bat out of hell. And I feel like I've missed it, but I'm not chasing it here. And I'm just hoping I overall didn't miss that trade. You know, Anthony made a comment. I don't read everybody's comments, but he said, you know, and this is so true. When you see a bubble, you invest in it. George Soros. That's a George Soros quote. And I'll tell you that is something, as you have been in the markets for a long time, you think about that. If you see a bubble developing, jump on it. Like, you know, and it doesn't mean you have to stick with it forever, you know, but if you're about quote unquote catching the momentum, that's actually a pretty true statement.
By the way, we just got jobless claims roughly in line. So,
you know, I'm with Steve. I don't care about data. No, I'm just kidding. I know. I honestly care about inflation data because that's what everybody else cares about, right, Steve? And I care about.
The Fed doesn't seem to care about it.
Yeah, I know, but people think that they do. See, they the whole
because
thing, right?
they claim they do.
Yeah, and then we have the jobs data, and then obviously, you know, the big Fed meeting on the 22nd. Other than that, all the other stuff is just noise. Anyway, hey guys, make sure you visit our webinar sponsors. Make sure you go. If you guys want to learn how to get ForexAnalytix for free, you can, you know, join the reimbursement program with Forest Park FX. You can also learn how to get cashback rebates. You can't do both, but you have to open your account through here. You have, what?
Can't do both.
No, you can't do both. But you can actually contact them right here on Skype, or you can email them directly. It says brokers at ForexAnalytix, but we don't address that. The guys and gals at Forest Park do. And we've been working with their team for years, and it's cool. I'm enjoying getting cashback rebates. First time ever for me. So it's
you know what we could have done, Blake?
Yeah, cool.
I saw a tweet on Twitter that Hedgeye, they actually took out $1 million PPE loan. We could have gotten that government money, but we just play it straight. So anyway, you know, it kind of aggravates me that people that were running a successful business still took advantage of a government program, took forgivable loan. Sorry.
That's one of the reasons why Josh Brown, downtown Josh Brown, that guy, he came under a lot of fire.
Oh, he did it too?
Yeah, like a huge one. I mean, I just you know, you just
moral hazard, guys.
Robert De Niro did it too. So anyway,
hey, we got an interview. I'm sorry, didn't mean to.
You know what? We have a new guest.
Oh, good.
That hasn't been with us before, and maybe you guys know him because you guys did some Real Vision interviews when Joe was around. Travis Kimmel.
I don't.
Hey there.
But
right. He's the president. So Travis is with us.
Awesome. And yeah, I actually only did one Real Vision piece.
Okay.
And that was and because Joe wanted, it's weird having a camera crew come into your house, and after COVID hit, obviously
your neighbors thought you were under arrest or something, maybe.
What's that?
Your neighbors thought you were under arrest or something.
Yeah, no. Anyway, all right, guys. Have a great interview. It'll be interesting to hear from them.
Thank you.
Enjoy.
Hello, Travis.
Bye.
Okay. Hello, Travis. Nice to meet you.
Hey, nice to meet you as well. Thanks for having me on.
Great to have you on. And don't worry, you could be yourself, sarcastic. I read your Twitter handle and I appreciate it. Okay. So were you going to share your screen at all and show us anything, or you just want to talk to me today?
You know, I think I'll spare everyone. Most of my, I think you all do a better job of TA than I do. I tend to approach it from a little bit more of a big picture analysis.
All right. Do you want to show you worked on the lighting? Do you want to use your
video?
Video?
Sure. I'll turn this on.
Okay.
Hey, that's me.
Hey, Travis. Nice to meet you. So why don't you tell us about your foray into the business, what you were doing? Were you always attracted to the markets? What was it that led you to point B where you are now?
Yeah, sure. So it turns out I got a philosophy degree in college, which is pretty awesome, but you graduate and you quickly realize that the philosophy plant is not hiring. So you have to find a real job. And that's what happened to me. That sort of led me into, I've always sort of been interested in finance, but didn't really have a path in. You know, I come from sort of humble beginnings, and the background in philosophy led me to software development of all things. because you have this, there's this similarity between symbolic logic, which you study a lot in philosophy, like arguments and whatever, and then coding. So it led me down the path of being a developer. And I did that for a little while, sort of self-taught developer. And then I had this great manager who looked at me at one point and was like, look, if you ever want to be good, you're going to need to go get a CS degree because you're a little bit rough. And he said, or you can start, you can try managing this team of engineers because you're technical enough that I think you could be good at that. So I went to the management side because the money was better than going back to school, and did that for a while and realized that the tools in the space were pretty underdeveloped. And so I ended up creating with a friend of mine this company, SaaS company, where we built out tools to help, sort of like if you imagine Salesforce, but for software engineers, like big platform tools to help software development. And it was in that process. I was the CEO of that company for 5 years, and we sold it about 2-3 years ago now. And it was through that I got more and more interested in finance. Nothing gets you interested in finance like running a freaking P&L.
Right.
So the bigger we got, the more discipline I had to get about that. The more I started to understand, I'd say finance from more of an operator perspective. And then the idea of taking that lens and looking at companies with it and looking at, sort of macro events through that lens is pretty interesting. I mean, you're always kind of chatting it up with VCs about the macro, in part because you strategize with them to figure out when you might want to exit or when you might want to raise a round. And so it became more and more relevant to have this read on macroeconomics because we were trying to time, how much should we raise? When should we raise? Is now an opportunistic time to raise, or are the market's feeling a little weird?
How long ago was that, Travis?
Boy, that aspect of it started probably in, our first round was sort of it's a seed round where you're just a couple guys with a PowerPoint deck. So I think that was around our Series A, which was probably 2017, 2018. Okay. That's when it became, material to the business. Okay. But then markets proper, gosh, I'm sort of a newbie. I just read a lot. I've probably been paying attention to markets proper for about 2-3 years. But okay. Ravenously.
Okay, and how did you meet Raul?
So Raul and I met. I was a customer of Real Vision first as part of my Learn Everything, and really, really enjoyed the way that Real Vision goes into depth on stuff. It's not just the sort of, it's not the same kind of like talking point stuff you get a lot on like the major networks. It's really just sort of like deep analysis. And so I was consuming a ton of that and just reached out to Raul and said, largely to say thanks. I think it's really fun to have something like Real Vision in the world where you can kind of train up. And then we hit it off. He was asking about some technical projects, and at which point I think I gave him some dubious advice that I'm now helping mop up. But we kind of hit it off, and then at a certain point he said, look, would you be interested in coming along and helping us ramp this thing up? So I thought that was a really interesting opportunity and came on board.
Okay. All right. Have you ever been to Little Cayman?
I have not yet. This whole pandemic thing kind of put a damper on that. I had a trip teed up. I look forward to it.
Yeah, because I've interviewed Raul a few times, and he would do it from his house and all the wood, and what a beautiful place to. I'd have a hard time trading because I'd be looking at the ocean all the time. So,
totally.
Let me ask you this: you've been with Real Vision how many years now?
It's not even a year yet. It'll be a year coming up in December.
All right. So, as a customer, who are the guys that impress you? Their narratives and kind of really resonated with you enough that you might even consider taking some risk or avoiding risk based on what you heard from them.
Yeah. So I think the things that I tend to like the, contrarian style, longer term analysis. So I really like Brent Johnson, the whole dollar milkshake theory. I think that I think that's fascinating because I would say some variant of that inevitably has to play out. It's just a question of whether or not you can catch the wave at the right timing. You get this to my understanding, the essence of that is that you have the dollar sitting in the position of the global financial system that gold used to sit in. You know, it's
Right.
sort of this prime asset, and people borrow it and lend against it, and lend it. And so every time, I know there's a lot of talk about dollar creation and introduction of dollars into the system currently, and that's true. But every time you create a dollar, you create an equivalent amount, or you actually create more forward demand for it. And so it's this really weird push where the more dollars you make, the more you're creating forward demand for dollars, because all that debt needs to be paid down sometimes, and dollars are created through debt. So I find that theory to be very compelling, and I think that again, the big question is, can you catch the wave at the right time? Which
Are you
it's
short
always the question in
euro?
trading.
Are you looking to short euro at about 120 or something on this little pop here?
Yes, I've got a bet. I've got a Twitter bet that I think is still in effect
Oh,
about whether
Twitter
it hits one. Yeah, we started at the beginning of the year, whether it hits 115 or 125 first. I'm on the 115 side. We're doing all
Okay,
right
so
far.
what happens if you're right? Do you get like a retweet? And if you're wrong, do you get blocked?
I've already blocked. so
But
I don't know,
pretty high
maybe I'm
risk
wrong.
stuff, man. It reminds me, people used to say, Dale, well, I'm paper trading right now. Now people can use
totally.
demos, right? So I go,
Yes.
what happens when you're wrong on a
Yeah.
paper trade? Do you get a paper cut?
Yeah,
You know what I mean?
probably.
So anyway, okay. So you like Brent Johnson? I mean, Raul has had Real Vision has had the best of the best. All the guys out
Totally.
there. I mean, the content's. I'd love to trade. Be able to trade my interview book with Real Vision, so I could get some of those guys on the air. I'm wondering what's new with Real Vision. We may as well make this a commercial for you guys.
Yeah, sure. We actually have a lot of stuff coming up. There's been a bunch of projects that we've kind of been in skunkworks mode on. So there's a couple things that we're focused on. One, there's this community that we stood up a real kind of early version of called the Exchange, and we just re-released that. We rebuilt a bunch of the tech, and that has just shipped. I don't know if I'm supposed to be talking about it, but you can go check it out.
News.
This is an exclusive.
Okay, all right.
I'll probably get slapped for doing this a little bit, but go check it out. There's a community on there where people talk about trading. They'll put their trades up there, post their thesis. We get some pretty lively discussions on there. It's awesome.
Collaborative. I'm a big believer in communities. You know why, Travis?
Exactly right.
Everyone only has two eyes.
Yeah, exactly. And you get these, and you can have all these other people who've got your six on that stuff. Yeah.
I mean, and we do it. That's what you're on right now. This is a community. I'm a big believer, and we have member chat rooms where people share their charts and ideas. I'm a big believer in this type of collaboration, and it's kind of trading can be kind of an isolated affair, and you have a chance to exchange ideas. So kudos to you in starting a community and people being able to exchange ideas and actionable ideas as well. So that's new. I told Raul Paul to do that about 5 years ago. So tell him congratulations on finally getting around to it. And what else you guys have going on with development?
So I will say Raul has some pretty cool stuff coming up next Friday. And I don't know if I don't know if I'm allowed to spoil it, but keep your eyes on our Twitter feed. Raul has been digging pretty deeply into crypto. He and I kind of go back and forth on Twitter. I'm sort of in the crypto bear camp. He's a huge crypto bull. I think in the end, I would say crypto has a bunch to offer the world of finance. And I think that will all end up playing out. Raul's super passionate about tracking that stuff as it plays out. I sort of watched a lot of this, the tech bubble stuff happen. And, so I think we could see a big rinse before a lot of the more end game tech comes in. I think in my view, that's pretty likely. But Raul and our team have been doing a great job of chronicling all these developments as they emerge. And so independent of, price fluctuations of various crypto assets, the coverage on the tech,
he prefers.
and
I
the
think
players.
one of his big themes, Travis, was Bitcoin over gold. Okay,
Yeah.
so he would debate people that were gold bulls and
Totally.
saying that Bitcoin was really the way to go. It's portable gold. You put it in a little computer thing and carry it across borders. It has all the portability. I don't think it may not have the privacy issues now that governments are coming in and trying
We'll
to
see how that
find.
plays out. They're
Yeah.
rolling hard lately.
Yeah. Okay, so you're kind of bearish crypto. Does that make you, with what's happening here, inflation, if it's not transient, and then you think about the milkshake theory, and that makes you not want to be short the dollar. What do you want
That's
to
right.
own in an environment like this?
So I would say I'm more of a crypto skeptic in large part because it hasn't been tested. I'm not an outright bear. Like, I wouldn't short it. I mean, it's a hard thing to short.
Yeah. Okay.
But I think that we will see. In my view, what happened last March was not really a bear market. It was almost purely technical. You had these volatility plays that got kind of washed out. I just don't know that we've seen the proper end of the business cycle yet, because I look at the balance sheets of aggregate businesses in the world, and they just haven't been cleaned out. They're still just loaded up with debt. And to my mind, the end comes when, over a period of a year or 18 months at least, that stuff just sort of gets washed out. Like, you get these weak businesses that die off.
Corporate debt.
Yeah,
Is
private
that
debt,
the biggest
largely.
bubble for you, Travis? And I've looked at the charts. I could show you. I could share my screen, and I look at, and this is investment grade corporate debt.
Yeah.
So, I'll share it here. And
I don't know if it's the biggest bubble. I think it's possibly the most fragile bubble. There's these guys. This guy Richard Vague has done some really good work on how private debt is the thing to watch when you're sort of
Private debt?
tracking private
Okay.
debt. Yeah.
Okay. So would that be mortgage debt?
Mortgage debt would be a component of it on the household front. Yep, for sure.
Okay.
Also, you see a lot of junk debt out there these days. LQD, Raoul nailed some of these ETF trades back last March. He was pushing to buy puts on these, and I think people who ended up doing that did really well.
Okay. So, I mean, normally problems in the economy start with credit, right?
Yes.
So,
Agreed.
this is, what we had. This was the COVID crash, right?
Yep.
And I don't even think the Fed bought one corporate bond,
Totally.
but just jawboning
They
it
just
brought
threatened.
it back. But we've had two successive lower highs here in investment grade corporate debt, and people are even flying for yield for anything. They're buying junk, and the spread between junk and corporates are is as narrow as it's been for a long time. So I agree. What do you think?
You're starting to see some of this stuff in China too, right? Like,
oh,
you're starting
my
to see the
gosh,
credit
yeah.
roll. It's getting pretty ugly.
Yeah.
So
Yes.
look, I'm a boring guy. I'm a fan of bonds and dollars. I'm still,
Okay.
until we see the big rinse, I'm just sort of I'm a fan of, the nice thing about bonds is you can just sort of park there and wait for trouble, and earn some sort of horribly small yield, but at least it's positive.
Well, I've talked to guys that said we're going to go negative yield on the bonds.
I could see it. I think that you would have to, the Fed is sort of pinning the front end here. So they have both the standing repo facility, they've got the reverse repo, and the effect of that is to add, it's like a buffer stock mechanism on both sides of the front end. So I think the front end is just going to stay where they want it. But as long as that ends up being in the current zone, which I think is like, 5 bips, then there is a carry trade available to people who buy farther out the curve and just hold. Because if the front end is going to be at 5 bips, since they have all these mechanisms for pinning it, you can buy out the curve and just hold and get a carry from those bonds maturing into shorter duration bonds. And so I think we're going to start to see more and more pressure on the back end of the curve, and the thing is just going to sort of pancake. I mean, you saw this stuff play out in Japan. It's typically what happens when you have a ton of debt in societies.
Yeah. So if the long end is weaker, actually the banks would like that with the yield curve rising instead of inverting, right?
I
That
think
would be good for banks.
That's the theory. I think banks are in a tough position here because it would be good for their ability to lend more. That's how I would phrase it, because it gives them a wider spread to work with, and so they can build a more diverse book of loans. But the flip side of that is that it would be arguably really bad for their existing loan book, because they have all these customers out there, which are the large, these zombie corporations. And those zombie corporations, they are effectively relying on being able to roll their debt, right?
Yes.
So
rollover.
they just, they just don't have the ability to pay that debt down when it matures. So they have to be able to roll it forward. They their P&Ls rely on the current financing costs. So if you get a meaningful rise in yields, I think that's a real problem for the banks who are, I think it's a real problem for banks' customers, these large corporations. So I kind of think the banks are in a tough position. There's not a great outcome for them here.
Okay.
And I think that all nets out to lower yields in an effort to you think about the Fed's mandate. The Fed has an employment mandate. And if you look at how many people these zombie corporations employ, and you're just thinking in a very simplistic way, how do we maximize jobs in the economy? You keep those things afloat. So you press yields down, get her done.
PPE loans and all the support levels. One of our attendees wants to know if you have any thoughts on the potential repo crisis that's happening. They're doing reverse repos to sop up that liquidity. What's that about, Travis? Do you know?
So I've got if you go on my Twitter, I've got a pinned tweet where I walked out some of what I think the implications are. And so running through that stuff, effectively what the Fed is doing, there's some references on there that might be useful if people are interested. But effectively what the Fed is doing is they are holding the front end up. People think of the Fed as pressing rates down. There's an element to that on the longer duration stuff, but the front end is being held up by this reverse repo.
Because that's draining reserves, right? Isn't that drain? They used to call them match sales, I believe.
The reserves has this weird thing where that word is used in two different senses. There's banking reserves and then there's reserve assets. It is sort of draining reserve assets, but you don't use proper bank reserves in the reverse repo. It's a really weird little nomenclature quirk. It's effectively warehousing cash. So the reason that bonds work so well in a sell-off is because when people sell all their stuff and they get cash, they got to put that cash somewhere. So that cash goes either into banks or into money market funds, which are just arb houses. Like they literally take your cash and they buy bonds for you with it, eat some of the spread and give you whatever is left over. And so now what we have is we've super generous. So right now what we have is this situation where we've forced a bunch of cash into the system by pulling forward a lot of these, like forced liquidating bonds and whatever else. So there's a ton of cash in the system. And if we didn't have the reverse repo facility, my expectation is you would see the front end of the curve deeply negative already. So they're preventing that, because if you got a negative rates on the front end of the curve, it would blow up pensions, insurance, everybody who relies on this presumption of positive rates. It's arguably also illegal with the Fed charter. So they have to do something. And so they have created this massive buffer stock where they're like, screw it, we'll just pay you 5 pips. And so it's a really interesting situation where they're holding up the front end of the curve. QE, it's debatable how much pressure it puts on, but it's sort of pushing down the back end of the curve. Plus you have this carry that you can get by just moving farther out of the curve. And the final piece, which Steve Van Meter, who if you haven't had him on would be a great guest, he pointed out to me is that the Fed has increased the moneyness of treasuries recently. So let's talk about what that means. When certain organizations have to report on cash and cash equivalents, and they have levels that they have to keep of that stuff for reporting. Typically cash and cash equivalents is like really short dated stuff, right? You're talking like, I don't know, 3 to 6 month bonds. It's got to be really short dated, so there's almost no duration risk. And what the Fed has done with this standing repo facility is that you can buy longer dated bond, you can buy like a 10-year treasury, and you can swap it for cash with them at any point. So because it's a standing repo facility, there is now a known quantity where you can just swap that stuff out for cash. So let's say I know I've got a lot of cash on hand. I'm a big corporation like Apple.
Yeah.
Now, typically they hold all this nearer dated collateral because it has to be cash and cash equivalents. But if they have the ability to go out the curve, buy a 10-year, and then whenever they need to show on their balance sheet cash and cash equivalents, they just reverse repo that thing, then it's literally free money. So they have increased the moneyness of all treasuries. Now, I don't think Apple is a great example there because they're not the type of organization that would do this. It's more like money market funds and large entities that warehouse a bunch of cash. But by standing up that facility, you have a really interesting side effect where you're offering effectively free carry to large actors out the curve,
Wow.
which I think will just continue to press this stuff down. It's a very interesting move. I think it's pretty smart on their part because it allows them to do an operation twist, except for the market does it. They just sort of like offer the operation twist to the market as a place to get.
Could they continue that strategy if they go ahead with the taper?
Oof, the taper. Let me think.
I'm having
that.
my clothes
I'm
let
not
out
sure.
from the pandemic. Taper doesn't apply to my life, but I was wondering if they could keep that game going with the tape. Do you think they will ever taper?
I don't know that they'll taper. I think a lot of this is just optics management. I mean,
all right.
The funny thing is that the reverse repo rate was 0 for a while, and then they upped it to 5 bips. And I think one of the things that is underpriced currently is that is effectively a tightening. Like,
right.
It's a really small one, but I think there's just sort of playing around here, seeing if they can create themselves a little bit of breathing room. I doubt we'll see an outright taper. I think the markets would just panic. And if the markets panic, they sell off, you get a flood of cash into the system, and it worsens their problem. And so they're in this weird thing where they're trying to create a little breathing room for themselves without just causing a panic in the markets. And I think what that means is they have to try to get this reverse repo cash pressed out the curve. It's the only way for them to do it. And again, Steve Van Meter is focused on this a bunch. He's got a lot of cool thoughts on it.
All right. Well, I appreciate that. I want to switch gears and wrap it with this. I was talking to a trader friend of mine, and Bitcoin price, Ethereum price, whatever. This is more about blockchain. And he told me that he heard, I don't want to, I'll name drop. He heard an interview with Mark Yusko. I've interviewed Mark too. And he said, how people are very confused about what to believe on the news.
Yeah.
That what's fake news and what's real news. Should I take ivermectin? Should I get a vaccine? That eventually that news is going to come through the blockchain, which is going to be able to have to verify whether or not what you're putting out through the blockchain has to be verified, so it can become kind of a venue for getting more credible type of news coming through the blockchain. Have you heard of anything like that, where we get our information, not just crypto exchange and monetary, using it for shopping, but you could use the blockchain for information and have it be more reliable coming through the blockchain? Because I don't understand the blockchain. I thought maybe you would.
I do understand the blockchain.
Okay. All right.
In fact, it's quite close to, it's very similar structurally to a bunch of tech that I've worked with. I am a long-term crypto fan. I will probably forever be a blockchain skeptic because, this may just be because I'm a technologist by background. I don't see a ton there. To me, it's basically just a distributed database. Now, I will say the trope that's being played with is this chain of trust thing. If you want to read a really good book on it, check out Snow Crash, I think is the one, Neil Stephenson book. It's science fiction, but it explores these concepts, and it's a really fun read. So the idea here is that you have a trusted
distributed database.
That's basically what it is.
Okay.
Yes, it's a distributed. It's a spreadsheet. Is the best way to think of it if you're in finance. Okay. It's a spreadsheet that a lot of people have to verify every time you make an edit to it. That is the
I
essence
see.
of what the blockchain is. So it's a
Okay.
ledger that that is difficult to falsify. That is the value of it.
Okay.
Now the thing, Bitcoin is literally just a record in that ledger. It's like a row in the ledger.
Okay.
So to me, the idea that that is inherently valuable, I am a skeptic on that. I just don't know that I agree with that. But
Okay.
I think that the tech has some interesting applications. To your point, this idea of verification of news, I think tech gets sort of hand waved a lot in the same way that just sort of like magic does. Like in a story, it's like, and then magic came along and it was all solved. And I think AI is a great example of this. Like, let's say we created AI. What would the first problem be? Teaching it. It's the same problem we have when we create little tiny intelligences. I mean, I have a kid. You know what the biggest problem is? Pedagogy. It's like if we already create intelligence, right? We know what the problem is after you create it. It's teaching the damn thing. So I think that AI is this sort of like, when the AI comes, it'll solve everything. I'm like, no, what it'll create is the need for better teachers. And so I feel the same way with this technology about like, you know, the trust chain and all this other stuff. I'm like, sure, I think it is possible to have a very indelible record that we create, but it's just sort of punts, you know, that's a useful artifact, but we still need to figure out like who's validating it. How do we know that it's real? What is the mechanism around which we arrive at reality? And ironically, to bring this all back around, that's called philosophy. There's this entire branch of philosophy called epistemology. And like, it's been a problem for thousands of years. I don't think the blockchain solves it, but it might be a useful tool for us.
And your degree.
That's right.
See, you know, you're able
They'll
to
need me
apply it.
eventually.
I'll tell you what, Travis, I really had a great time talking to you for half an hour.
Likewise.
I'm very glad our paths crossed on Twitter.
Yeah.
And
Thank you for reaching
you're
out.
really not sarcastic. You're you enlightened. You really enlightened, I think, our community. And I learned a few things from you. And after you go through an interview with me, Travis, you're now my trading warrior brother. And
I love it.
I wish you a lot of success on in the markets, and continued success.
Likewise.
At Real Vision, and say hello to the boss for me, and let's do this again down the road.
I'd love that.
All right, Travis Kimmel, everybody, and you can follow him at Colorado Travis. Anywhere else people they could find you on Real Vision? Or
yep,
what do you
on
think?
Real Vision. I just encourage everyone to check out the exchange. I think we're going to keep rolling out some fun stuff there. So another fun place to chat finance.
All right. Really glad that I met you. Pleasure
Likewise,
to meet you.
Thank you.
All right, Travis. So that's a wrap, everyone. And remember, don't just count your blockchain or your bonds, count your blessings. And we'll see everyone tomorrow for the big number. You could join the crew in 13 minutes for the morning edge. And that's a wrap. You're very welcome, Scott, Ingmar. I'm glad you guys enjoyed Travis. I guarantee you we'll get him scheduled to come back. So adios, everyone. See ya. Good hunting. See you tomorrow. Get some sleep tonight. Adios.